to a rare Sunday supplement on a Saturday evening. This one will be released tomorrow on the usual channels, which is my LinkedIn and also the Partners in Property blog. But it's all done and dusted, and I've got an incredibly packed day tomorrow, so I won't be able to squeeze the live in tomorrow at any point, I'm afraid. So I decided to do it tonight. So a little insight there, the supplement does usually get finished before its deadline of 6:30 in the morning on a Sunday, but not every week. It just depends what I've got on, and also what's been going on and how much extra work I want to do, how much analysis I want to do. So thanks for tuning in, and for those who've tuned in before, you'll know that I like to start with a quote, and this week's is, "It is always darkest before the day dawneth." And that was first said by Thomas Fuller, the 17th century author. Now, before I get started in earnest, I wanted to just give a push for our property business workshop on Thursday, the 16th of January 2025, hosted by Rod Turner and myself, a one-day standalone workshop covering productivity, planning and financial accounting and bookkeeping. Why have we put those together? Well, we constantly see property businesses struggling with appropriate financial reporting, accounting and bookkeeping, and making the same mistakes time and again. This is to help get a complete handle on the financial performance of your company or group when you aren't at a level yet where you can afford a CFO or financial controller. Set it up correctly once and then just iterate from there. As always, it'll be action-packed and content-filled day, which will stand alone in helping to advance your understanding as a property business owner. Ticket sales are live. We've got super early bird tickets. We sold over half of our allocation of super early birds, so there aren't loads left at the moment. They've got a genuine 25% plus face value discount on them, and they're available now. They're in limited numbers, and they're at bit.ly/PBWFIVE, PBW5. Thank you. So, as you'll know, it was a pretty quiet week in the world this week, really, wasn't it? Well, maybe not. What we're going to do is we're going to try and stick to the macroeconomy of the UK going forward and the likely shape of the UK property market, because that's what you're here for after all. So, getting straight down to business, Chris Watkin asked himself that question one more time: what is currently happening in the UK property market? And this report is from a week containing the budget. Next week's will be a week containing a base rate cut, of course, although that's all been lost in the melee of all the headlines this week, naturally. Chris is a property stats guru who analyses the UK portal data, which is aggregated for him by 20EA on a weekly basis. I absolutely love real-time, or as real-time as possible, snapshots and pictures of the markets that we can piece together. There's nothing better for staying informed. So, listings took another dip, but nothing that didn't follow seasonal trends year after year. Only the more motivated start listing their houses for sale at this time. The tyre kickers have had their pot shots for the year. Reductions still look good for buyers, at 13% of stock being reduced compared to the 5-year average of 10.6%. That's measured on a monthly basis. Sold subject to contract dipped from 26,000 last week to 24,000 this week, but it remained far higher than 2023's numbers, 17% higher for the same week in 23, and higher than the pre-COVID averages, so it's still about 7.5% above the 2017 to 19 averages. The fall through has also ticked up a little, just over 1 in 4 sales falling through at the moment, compared to just under 1 in 4 the week before. But the budget has not had a catastrophic effect by any stretch. Let's keep monitoring. The fall through rate was 40% for 2 months after the disastrous Truss Kwarteng mess of 2022. Net sales moved ahead of 2022's number at the same point in the year last week and look set to stay there. Remember how bad those last 2 months of 2022 were. A healthy print on the year and 5.8% above the pre-pandemic average of 2017 to 19. The real-time expectations at my end are fewer investment transactions because less stacks up at 5% higher rate additional duty stamp compared to 3%. That's pretty simple economics. Behaviourally, I already know on the ground that agents who are more honest are telling my business partners that buyers have evaporated. Time to press those advantages. However, investment transactions were already really low. We were looking at 9% of mortgage monies on Q2's figures being used for investment purchases, and 1 in 10 houses being bought for investment purposes, according to Rightmove's most recent article on the subject. They unfortunately don't share their source data in any meaningful way, unfortunately, so we have to trust their commentary, but it doesn't look out of line at all. Bear in mind the sector is 19% of UK housing, 10% or 9% is about half of where the replacement rate might need to be. Mortgage data excludes cash buyers, of course. So suppressing these yet further, even if it moved them from 9% to 7% of mortgage lending, would be a minor point, really. Now, we know around 20%, again, according to Rightmove, of houses are ex-rental. So we're losing 20% and we're replacing with about 10%. That's where the numbers are in real time, to the best of our knowledge. There's lots of people denying that the sector is shrinking and not interested in hearing these facts or whatever. We'll have to wait about 18 months before we have the real data, which is the English Housing Survey for this year, which won't be released until December 2025. It's up to anybody else if they want to think about doing anything about it in real time, isn't it? So on the flip side, these newly created stamp duty bumps, and I use the word bump rather than a cliff edge. This is at 125k to 250k, and it's also at 300k to 425k, because that's where the two changes are. So secondary market and then first time buyers, apart from anything else. This will nudge behaviour the other way round in the first time and secondary markets. Everyone paying over 125k for a house is paying the extra, as long as they're not a first time buyer, if they're in the 125 to 250 band. And then first time buyers will be the most motivated, because the marginal band between 300k and 425k is 5%. And so £7,500 of extra cash to find or borrow from the bank of mum and dad will force some transactions through before April the 1st, 2025. You would expect, from the point at which we're starting from, the impact to be more volume before the 1st of April and then less volume after, as the market adjusts to the transition, with future volume dependent on the pace of rate changes. So what? As I always try to ask myself, well, list your sales sensibly. List now or soon. Certainly prepare to list on Boxing Day and get carried away in the usual hype, or make an impact on the first weekend of the new year after the kids are back to school, depending on what you're selling. Line up some decent lawyers on your side as well. If you're selling investor-only stock, you might need to sit on it until 2025. I think the auction sales will be tumbleweed in November for the vendors. There's still the same money out there looking for the right lots and bargains, of course, but many buyers are going to be looking to load the entire new 2% onto the vendor, this extra stamp duty, to make their already tight margins hold up. December looks again likely to be very quiet, as it usually is, and a week further on from the budget is exactly what we're hearing and seeing in terms of numbers of people at auction viewings and the likes, and the number of calls we're getting from agents who are desperate to move stock on. So over to the macro man. The retail sales monitor needs a slot here because there are budget implications I didn't have room for last week on that front, or in that industry. The PMIs are finalised, and let's discuss them. Halifax's price index was also out, and you know we're not going to avoid the gilts and swaps. That section is slated to be retired at some point after 2027 at this stage, if ever. So the British Retail Consortium Sales Monitor then, up, remember this isn't adjusted for inflation, a massive 0.3% on the year for October. It's better than a drop, but it was below the consensus. The reasons cited, well, half term being a week later, making a difference downward for October. Budget uncertainty, alongside rising energy bills. Fashion took the biggest hit because mild weather delayed winter purchases as well. So the cost solely on the retail sector is pegged at $5 billion in the chief exec's summary. So that's employers' national insurance, business rates, and the national living wage uplifts, with just M&S and Sainsbury's between them this week quoting $250 million in extra costs for 2025. You can believe it. So the KPMG head of consumer retail and leisure sees increased confidence in households post-budget because they've escaped tax rises. I think I might take some issue with this, to be honest. Some employees will realise that next year's pay rise, those who are far enough away from the minimum, is likely to be very mean indeed, as it will all be going in increased national insurance for the employer. Some won't, but the news has hardly welcomed the budget positively as far as business is concerned, and jobs are likely to be much more at risk than they were. So I'd take issue with the sudden uptick in consumer sentiment. Perhaps before Christmas, perhaps before Q1 2025 cuts are announced. We'll find out on Black Friday, of course. Households on minimum wages might well feel more confident with a big rise coming, as long as their jobs are naturally secure. Without a lot of spare cash anyway, though, it's hard to say. those households do have a tendency to consume 100% plus of any pay rises, economically speaking, but that rise isn't coming until April, of course. My own take, retail businesses, buildings and associated jobs are likely to have a very tough time in 2025. There will be closures and job losses. The quantum of them may not move the needle much nationally, but if you have exposure in that sector as a commercial landlord, or you're looking at opportunities in the sector to convert buildings or similar, action will be needed and the time is now. There will be some streamlining and ever more empty property across the UK. So on to the PMIs and the related jobs report that S&P also produce. October, you know what it's going to say for jobs. A fall in permanent placements. Further slowdown of salary growth, vacancy numbers falling again. Why? Reduced demand, hiring freezes and budget uncertainty. The fall in vacancies was described as at an accelerated rate. The direction of travel is unnerving here and we're getting close to a more negative employment environment. I certainly updated my forecast for unemployment by a few percentage points for 2025 and beyond. I see us at risk of going above 4.5% now, whereas we just made it back to 4% unemployment, and I was clear before that 4.5% really was the ceiling unemployment level at the moment in the UK economy without there being a shock, of which we've had at least a taste of one with this budget. So on that note though, perhaps we'll backdoor our way to higher wages and higher skilled jobs, but that's because unskilled jobs will cost so much in comparison that the incentive to automate them is higher than ever before, both relatively and absolutely. Where this will attract attention amongst some consumers is that the fact that weaker business and weaker employment numbers and weaker direction of travel will influence the Bank of England committee to cut rates further, perhaps. However, let's be careful because there's a bit of a trap there, and I'll get into it in the deep dive when I talk about the Bank of England monetary policy report. So on to the PMIs, the slowest rise in business activity since November 2023, but still a rise just about. Export sales growing, but how long can that hold up? US tariffs are bad news on a couple of fronts for the UK, by the way. Directly, simply due to affecting how much we can export to the US, our biggest single buyer of exports as a nation. We export more to the EU in aggregate, of course, but not to any individual EU country. A little over 15% of our exports go to the US. And then indirectly, well, tariffs will provide some help to the US economy, but will inevitably be inflationary, but they'll harm global growth, which also harms the UK. So 20% extra tax on everything not from China changes a lot. It even changes domestically produced goods if they're made of more complex component parts. Think cars, for example. A lot of parts in the supply chain, even of American appearing manufacturers, are made all over the world. So, someone in the incoming administration will be explaining this to Mr. Trump in appropriate language, and we'll see if the tariffs go the way of the wall. On the wall, by the way, a quick précis if you're interested. Trump's administration built 52 miles of new primary border barriers. That's the first impediment that people encounter if they're trying to cross the southern border with Mexico. That can block access either for people on foot or for vehicles, where there were none before. The administration also built 458 total miles of primary and secondary border barriers, US Customs and Border Protection data shows. But the majority of those were replacements of smaller, dilapidated barriers. So replacement barriers and secondary barriers that are behind primary barriers don't add additional miles to the southern border's total coverage. So he doesn't always do what he says he's going to do, but he has a go, would be my simple summary. And I think with Mr. Trump, keeping it simple is the dominant strategy. So back to the PMIs anyway after that segue. The services print was 52, still growing, but at a slower pace. There's no point lamenting the budget uncertainty one more time, because now it feels like looking backwards rather than real time. The key takeaway from the services print that we didn't have before though, 52% of services companies predict an increase in business activity over the next 12 months. 11% predict a reduction. The rest fall into the about the same category. Now there's no quantum there of how much of an increase, of course, but overall, if you subtract 52 from 11, which is how a lot of the confidence markers work, or the other way around, you'd be looking at a print of 41, which would be seen as very positive whichever angle you come from. Services as a whole look robust in the face of the budget, and ultimately they define our economic success as a nation, or at least 80% of it. So we're working towards a conclusion that the budget batters certain sectors a lot harder than others. We are, of course, more interested in construction than the percentage of our macroeconomic output that it makes up, and the construction PMIs are also out. The strapline rises in October. Civils are still dominating the construction category, followed by commercial work, with resi still in last place. They describe a renewed decline in house building and optimism at a 10-month low. 54.3 was the print, which on its own is a solid number, but down from a massive 57.2 in September. House building slipped back to 49.4, so underneath that magic 50 level, contraction creeps back in. Elevated borrowing costs, uncertainty, and constrained demand were the reasons cited. This is much of 2024's messaging in construction. Construction is doing well. Great. It isn't really house building though, it's the other sectors. Oh. The current run rate, as explored a couple of weeks back, at around 150,000 new houses a year, is going to embarrass Angela Rayner in a year's time, unless the starts have really moved forward by an incredible amount, rather than about 25 to 50,000, which would look like the correct and optimistic range to me just now. Optimism is subdued in the sector with the lowest growth expectation since December 2023, a 10-month low which of course will be a self-fulfilling prophecy. Onto the Halifax House Price Index. They made the headlines this week. Everything seemed to be navigating budget fallout and US elections, of course, with them being the first major index to claim a record high print. The broader inflation rate since the last high, of course, are never mentioned, even though whichever measure you use, we're comfortably in double-digit inflation since then. Halifax saw plus 0.2% in October, plus 3.9% year on year, with the new number, according to them, at 294,000, passing their June 2022 previous peak. Northern Ireland is also still winning the devolved battle of the fastest rising market, as its comparative Brexit dividend continues to yield. They finally seem to be seeing the overall error of their ways at Halifax though, despite some incredibly bearish predictions since late 2022. Perhaps more noteworthy, they say, is that house prices didn't fall very far in the first place. No kidding. The 0.2% gain from the past 2.5 years is then rightly compared to the 21% gain between January 2020 and June 2022. So that really puts us at 21% in nearly 5 years. That's about where we are, not as high as inflation. They cite already steadily dropping mortgage rates. Well, we need to have a word here because they aren't watching the gilt markets in real time before they write these reports, which is a bit unforgivable to be honest, but their analysis honestly doesn't really seem up to the task. Our gilt and swap section is going to get heavy this week, folks, fair warning. Halifax sees Northern Ireland up 10.2% and Wales up 5.6% year on year. The North West is up 5.9% year on year too, with London up 3.5% year on year. None of the rest of the report told us anything we didn't already know. So, over to our beefed up gilt section this week. What a few weeks. Things have gone consistently against the borrowers for 5 or 6 weeks now. It would be remiss of me not to do what I always try to do, which is break ground, not be influenced by what others are saying, be impartial, and share everything I'm considering strategically. And so I'm going to make no apologies for this section being longer than usual. I start with the 5-year gilt. The path has been upwards for the yield, and therefore downwards for the price, over the recent weeks, because there was speculation over the budget, nervousness over the change in fiscal rules by Rachel Reeves, and also a spectre of an election hanging around across the Atlantic. Let's start there. America sneezes and the world catches a cold, they say. Everyone follows the Fed. There's some truth in these sentiments, and the US interest rate decision this week, which was a 0.25% cut, barely even made the headlines in the UK because of the election mania. What were markets speculating or worrying about? Well, a disorderly election, of course, with an unclear result. Either way, political affiliations aside, a luxury which I don't consider myself able to afford, a clear win in either direction was the best result for the world. That leads to a little calm. Mr. Trump, however, is not someone who lenders think a lot of. There's a fair amount of blind rhetoric celebrating his second coming. Everything is up, 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 up. But let's look at the reality for the week. The S&P 500 was up 4.7%, strongest week of the year. Bitcoin up 13% using pound sterling prices. Tesla is up 31.5%. Remind me why Elon is so keen on Mr. Trump again? And then the US 10-year note is down around 9 basis points in terms of yield, but it's up around 20 basis points on the month. So you know what? Not a bad set of results at all for markets. It strikes me that Musk has done what previous media barons have done for centuries, but more brazenly and arguably with more skill. I remain unconvinced that this is much of a long-term pair of bedfellows, but with his form at Twitter, get rid of 75% of the staff, without the issue of commercially ruining the brand, as he did there at X, because the US government doesn't really have one, his methods in leading government efficiencies might be brutally effective, and will have some fallout on some pockets of American society. To think the US 10-year yield is down is fairly mind-blowing. You could say, well, the base rate has been cut 0.25% by the Fed, so it's dropped by less than the base rate cut. But really, that had already been priced in. What I would think would worry lenders more is firstly the Donald's appetite not to pay his creditors. Remember the 6 bankruptcies. And secondly, his rather loose approach to controls when it's regarding one of his major objectives. There's no price tag on safety when it comes to border controls and mass deportation plans, which remain to be seen, of course, but I refer you back to what I said earlier about the wall. The bare minimum here is that he has a go. So I don't see a smooth path downwards for US interest rates from here particularly. The Donald also has his own ideas about the Federal Reserve. He subscribes partially to the Liz Truss school of political control, where you don't want independent organisations getting in your way, even if you're an incompetent, because those checks and balances aren't needed. The ultimate check and balance is the international bond markets, even for the mighty US, because of the size of the debt and the deficit. It's a really serious concern in percentage terms, and if spending continues unchecked, especially with more tax cuts, which with Republican control of both houses looks like a penalty kick, just servicing the debt becomes a big or bigger problem. I honestly think Trump thinks default is the way forward, but it won't be up to him to do it. Pretty typical politics, really. He has a similar approach to climate change, etc., which is why he will drill, baby, drill. This is economically a great approach for the US if they don't care about the externalities of what they do, but they'll be absolutely embarrassed by China and the likes for their renewable efforts, which are more strategic and, to be honest, less driven by climate concerns as well. They just want to be world leaders in future tech that will drive the developed world, and they've made all the right moves to do that. So, I have not there painted a picture for particularly quickly declining yields, in my view. If the economy does take off, and on paper it should in the US, more likely than ever to avoid a soft landing, let alone a hard one, the issue will be the trickle down or lack of it to the people come next election. Goodness knows whether Trump will still be trying to stand after proposing a constitutional amendment, once that's also been explained to him. A hotter economy doesn't want lower interest rates, please remember, even if the deficit servicing is coming at an insane cost. Import the relevant amount of that logic over to the UK. The again dispassionate economic analysis of the Rachel Reeves budget is that it will create some extra unemployment, and under the current plan, the growth in real household disposable incomes over this Parliament will be miserable. The most miserable since the last Parliament, as it goes. So there's a departure there then. There's a much higher probability of growth stuttering in the UK compared to the US, based on the events of the past fortnight. That means the UK may need to cut rates, whereas the US may need to keep them higher, all else being equal. We're going to have another little segue here though. People struggle to stay politically neutral. I get it. I come from a school of, you don't get it unless you work for it, and I mean really, really hard. There's no point relying on others or the state to give it to you. You have to earn it. It doesn't mean there isn't luck. Luck is massive, both good and bad, but you really can make a lot of your own. You never get lucky at a networking event, if you know what I mean, if you never go to a networking event, for example. However, some of the commentary that's come out since the budget hasn't been helpful. You don't tax your way to growth. Well, that's not technically correct, of course. If you tax 40 units and you borrow 40 units and you spend 80, or spend and invest 80, that 80 is growth. It is in the national income figures, in the GDP calculations. Now let's zoom out that little bit more. Consumer spending hasn't been growing or grown over the past Parliament once inflation has been taken into account. This is the single biggest component of growth. So how have we had any growth then? Well, government spending. This isn't a sustainable way of growing, of course. Spending a bigger and bigger percentage of the national income on government can't go on. But there are plenty of developed nations who spend a bigger percentage still. This method of growth is what still allowed us to grow, not per capita but overall, over the past Parliament. The pandemic was a huge part of that, of course. What's also been happening though, people have been saving because they've been concerned, much more than they were before the pandemic. If they save, they don't consume, so consumption continues to struggle. If people, not business owners, start to get more confident, they will loosen their belts and consumption will grow alongside government spending. So there is a path to growth at 2% plus, which is 2% is the OBR forecast for 2025. Will we get there straight away in 2025 with major changes that will hit some sectors more than others, combined with new employment rights? Well, that's unlikely, you'd think. Although with the corporation tax question already answered, perhaps that's enough for SMEs and bigger businesses to get on with it. Look at the confidence figures from the services PMI, not to be sniffed at. So there's some short-term wins for growth that those shouldering a big part of the tax burden won't like, but they are factually correct. This has all got a bit theoretical, but don't get too bearish on the future of the UK. Unemployment going upwards never stimulates confidence, and a movement upwards looks about 95% plus certain to me at the moment, leading towards next April and beyond. After that, it could easily flip back as the business world keeps calm and carries on. A lot will depend on the margins. I also at this point have to shout out to inflation, food inflation particularly. That's hit consumers very hard in the US and to a lesser extent, but still a big one in the UK. Retailers will suffer, as discussed, from these changes in cost base increases, and they must pass a decent chunk on to their customers or hit their suppliers, who will have their own absolutely equivalent cost increases to consider. You'd expect therefore food inflation must go up, but are we in economic shock territory or not? North of 3% once again looks on the cards when this risk has calmed down a fair bit. North of 4% looks somewhat unlikely. I've started to believe more and more that the real inflation target is 3% these days anyway, in both the UK and the US. So I remain relaxed, but we do need to accept the budget changes are inflationary. This counters the case for putting interest rates down, particularly quickly, of course. But one more thing on that front that I've perhaps not mentioned enough over the past weeks and months. The yield curve. Many will have seen references to the inverted curve, and I've spoken of it in fits and starts over the past couple of years. Normally a very reliable recession indicator. But there's another theory here. The yield curve has instead simply reflected an artificially high base rate of interest in the very short term. And this was all put into place as a risk management protocol when supply side prices for commodities and other goods spiked massively in 2021. So the inverted yield curve didn't tell us what it usually tells us, is what I'm saying there. So the shortest term rates are set by the central bank. That is the base rate ultimately. Those risks did not emerge. We did have an inflation bulge that actually was transitory, but the transitory period was much longer than the central banks and the economists predicted. Well, apart from some economists, of course. And there were also secular trailing effects. And this is my real world 3% inflation post-pandemic theory. And this is very much in line with previous pandemics in history. Now the long-term rates are higher and the yield curves are flattening out a bit. The short-term rates are still artificially high, higher than the natural rate. That's the rate at which the economy doesn't expand or contract based on the base rate, but the gap's been closed. The problems really start to pick a number at around 4%, which is about the high end of the natural rate estimates at the moment, but it's also my estimate of the natural rate at this time. I'm in the sort of 3.5% to 4% camp. Now, my interest in the natural rate of base rate is limited. I'm interested in the 5-year UK gilt price and the swaps because it defines my debt rates and by extension my entire business model. That 3.5% to 4% has also been my estimated range for the 5-year gilt yield this year. That's had to be bumped up in the past fortnight by the events discussed, the budget and Trump. So as of today, I'm sitting at more like 3 3/4 to 4 1/4 as a sensible trading range for the UK 5-year gilt yield for the next 6 months or so. In that time period, I'd expect another 2 base rate cuts of 0.25% each, probably February and May. They won't change much at all in the gilt markets because the 5-year will still be trading around or below that new rate of 4.25%. And the markets are kind of worked out they can shrug off some of these base rate cuts, and that as more time goes on, the more I think they come round to my theory that we had this risk management protocol, and that need for that risk management has dropped away, so we can drop that base rate, but it's not really going to influence the 5-year and 10-year plus yield curves particularly much. They're still going to find their levels in the markets, find their equilibria. So what's really happened in the past couple of weeks is that it seems I might have been right again with my predictions for this year, but once again, not for all the right reasons. I've been told off, corrected, criticised and scorned for my mortgage rate predictions, which have been a bit bearish. I said a drop of maybe 0.5% this year on the rates. I looked at a post the other day from 2 years ago, so November 22, full trust repair mode, and Paragon mortgage rates were back to 5.69% with no fee. The reality is we're still higher than that today, folks, in the investment market. Patience is key in this game, as you know, but rule of thumb investment grade yield today, based on a 30% cost base for operating a rental unit, is 8.5% plus. There's a vastly increased from nearly zero to low risk of rates actually going up from here, not down. I still don't think they will, but I think you should be on your guard. And if you're sitting waiting for lower rates, I wish you all the best, but please don't hold your breath. Anyway, back to the nitty-gritty of the gilts and swaps. I'm hoping that segue was useful at least. It might be on this one so far. The 5-year UK gilt opened the week at 4.306 on the yields and it closed at 4.329. Sounds like nothing happened then, eh? Well, it closed Thursday at 4.373, having trended up all the way to the election announcement and then down after the base rate cut announcement, which I cover in the deep dive. We're still waiting for that down week to come back, which in honesty, I think it now will as we come back towards the middle of my range for Christmas, that's sort of 4%. Our discount, which has been in points for some weeks now, was preserved, even increased on the swaps. 4.01 last 5-year SONIA swap traded on Friday afternoon. And that's 32 basis points lower than the gilt close on Friday. Well, long may that last. It still compares very favourably with the numbers from a year ago that were 0.2% higher, but they were still only 0.2% higher now before I again. So those with net yield are okay. Those without, prepare to keep subbing your portfolios if you want to hold on to them, or get active with your asset management to force yields, restructure, sell and the likes. Well done for sticking with that part because it did get heavy. I never apologise for that. It's needed to get deep under the surface of the trends sometimes to work it all through and keep a balanced picture of the macro environment. I'm all to hear from listeners, especially if, as and when they disagree. I must make one anonymous shout out here to one PropTech CEO listener who stands out from the rest by remembering where we've disagreed previously and where my predictions look to have outperformed his. You know who you are, and it's part of what makes you the thought leader you are as well, sir. I don't expect to keep up that track record, but I will try my level best. So, goggles and scuba tank on for the deep dive. We've got no choice but to get stuck right into the Bank of England meeting notes and full Monetary Policy Committee report, because the output is so important for the future. I won't spend a long time on the outcome of the meeting. Suffice to say, rate cut 0.25%, the least surprising meeting for some time. 8 voted for cut, very nearly a complete consensus. The member dissenting being Catherine Mann, who I've described in the past as the hawkiest of hawks, or perhaps Hawky McHawkface would be better. Unsurprisingly, not conceding that a cut was the right move. Onto the report and the relevant parts. Disinflation is upon us. So remember, that's not prices going down, that's prices going up less quickly. So the bank expects CPI inflation back to around 2.5% at the end of this year, as the energy price drops have stopped and indeed reversed from the 1st of October, as far as households are concerned. Earnings inflation and services inflation are cited below 5%, but only just 4.9 and 4.8 respectively. The bank expects 0.25% growth for Q3 and Q4 respectively, which would put the annual to around 1.75. Well, that's not bad in today's world, and it looks about right. You'd hope it would be. There's about 7 weeks left in the year, so they really should be getting these things right at this stage, but that's no guarantee. The committee thinks that the labour market will continue to loosen, not directly mentioning the budget at this point. So this suggests that all else equal, they would rather cut rates to stop employment going backwards. But remember, inflation remains their one thing. And then they look at 3 potential alternative cases for inflation from here. Fast dissipation, thanks to shocks being largely over, as I talked about earlier. Now, apart from the budget shock to jobs, several non-partisan economists are using the word shock about this budget. This isn't coming from me. The second case is some slack in the economy to allow this unwinding to take place. So a bit more unemployment for a bit longer is what they're saying. The third case is structural shifts in wage and price setting behaviour. Inflation becomes the norm. It becomes baked in. You could argue right now this is very clearly the case for rents, although those actively asset managing, if you speak to a more typical or traditional landlord, the modal landlord, 1 or 2 properties, they're still not putting rents up or seeing rises as a one-off or two-off where you spread an increase over, and therefore the bank, taking note of this, have boosted 0.75% in about a year's. So for me to try and simply explain this, Hunt and Sunak took from the future by freezing the personal allowance tax thresholds for so very long, and some other trickery. Reeves has brought some boosts forwards into years 1 and 2 of this Parliament, but at the costs of years 3 and 4. Reeves has also laid the groundwork to provide a bribe in year 5 for re-election. Reeves will need to change things in year 3 and 4 when we get there, and will probably do it by stealing from years 6 and 7. The forecast period is 5 years long, but when we get a couple of years further on, you see that we have those new years to borrow from before we get there. So they're not there today for consideration, but they will be by the time we get to years 3 and 4. I hope that at least makes a bit of sense. That's really the game that they play, or part of it anyway. The Office for Budget Responsibility, and again therefore the bank, see an inflation boost of about 0.5% based on what's being done in this budget. And that's then calmed down the rate at which interest rates are expected to go down, to more like the path I've been concerned we'd be on for some time now. Don't forget the assertion that the real household disposable income is only going to limp upwards by about 0.75% per year over this Parliament. Well, of course, that happens because if you create inflation, real household incomes have considered inflation already. So all else being equal lowers a real house increase by 0.5% if you add 0.5% to inflation. It's as simple as that. The bank continues their assessment sensibly from an economic viewpoint. What they don't know is just how I framed it last week. Some of this national insurance rise, plus the minimum wage rise and the changes in business rates, falls on the employer. Some will fall on the employees, and some will fall on the customers and other businesses and suppliers. How much? Well, it depends on the price sensitivity of the customers, so that's about their willingness and their ability to pay. It depends on the labour market conditions as far as how employees react, and how employers react, to be honest. And it depends on the fixed and variable costs of the employers and their alternative plans or homes for their capital that they risk. This also costs jobs. The bank doesn't know how to model this, being blunt, so they need to wait and see how it plays out. Well, that pretty much makes 2 of us. You could obviously look deeper at individual sectors and you would be able to predict more, as I have been in retail, hospitality and leisure, for example, because you know they have a big dependency on minimum wage staff, for example. They also have relatively price sensitive consumers, but we're still going to have to see what happens and when it happens as well. So then we had one of those sentences that makes the hairs on the back of my neck stand up a little bit. Monetary policy will need to continue to remain restrictive for sufficiently long until the risks to inflation returning sustainably to the 2% target in the medium term have dissipated further. In plain English, this isn't going to be quick. Time to heed that if you haven't been already. The bank sees the balance of demand and supply in the economy as a whole being about right at the moment, which will also be borne out by an okay economic performance, which has actually been better than about 95% of the forecasters forecasted at the start of 2024. And they're seeing these changes emerging during 2026 thanks to the budget. And that gives you an idea about what their models say in terms of how long this takes to play out. They've got inflation back to 2.75 in the second half of 2025, which looks a fair shout at the moment, if not higher. And they see pay growth falling to 3% per year at the start of 2026. I was expecting somewhat more of a shock downwards in April 2025 based on the budget, so we'll see who's right on that one when we get there. But the key number in all of these quarterly reports, and why I get into them in detail, is the forecast inflation number for 3 years' time. This is based on the forward curve for interest rates, which sees us at the moment getting down to about 3.75 in 1 year, and then staying there roughly over the forecast period. I'm concerned we've even slowed down on that pace, but whilst we're above anyone's estimate of the natural rate, perhaps we haven't. It's what happens when we get to that 4% or that 3.75. I'm not going to have an argument over 0.25%. That's what really matters. Staying there is now the bank's base case, rather than getting back down to 3%, or some of the recent primary school analysis produced by some of the major investment banks saying base would be 2.75 in a year's time, which now looks even more stupid than it did a few weeks ago when it was published. Forecast inflation in Q4 2027, 1.8%. The 3-year forward number was down to 1.5% last report, August, so this isn't positive, but it is under the target and it is within tolerance. If anything, the message that this sends is that bank rate could actually be more like 3.5% by the end of the period and all still be okay. It's very theoretical, this stuff, but it does really matter. They've adjusted unemployment downwards in spite of the budget news because growth in the near term is better than expected, thanks to this shell and pea game played by Rachel Reeves in the budget. And now they look to be about right or under-egging it. They get to 4.4% unemployment by the end of the forecast. Will they be about right about the pace of change and the scale of change? Well, we're going to find out then. Unemployment numbers are normally notoriously bad, but they don't look terrible in this report, to be honest. The bank still sees the overall UK economic growth as 1.75% max, and I still disagree with them. There is a path to 2% plus, but I'm not convinced that we're currently on it. And no, it wasn't Liz Truss's path either, although some of her ideas were the right ideas at the wrong time, but more by luck than judgment in my view. It's really this more permanent shift in inflation, or structural shift is the technical term, that I just want to spend a little bit more time on here. I've said over some months now that I think that 3% is the new 2% as far as the real inflation targeting goes. Well, this favours the property investor, although while we pretend 2% is still the target, it does mean higher rates. Well, why? Well, wages go up, debt decays more quickly when it's nominal, rents go up more, house prices go up more. This isn't a huge difference, but if this effect lasts decades, which it could do, even 0.1% per year on each of those is a gigantic shift over time when using leverage intelligently. That is the miracle of compound interest, folks. I've said that from studying previous pandemics, the 1% extra inflation tended to persist for up to 30 or 40 years after the event. Now, the world was different then and the inflation reasons were different, but with some similarities. Supply side shocks. In the old days, people were dead. In the new days, they're sick. They don't want to work anymore. They've been handed a lifeline by COVID that enabled them to retire, and a mixture of all the above. They're psychologically different, and they're finding ways to avoid work, some of them, from what I've observed. It changed people, and of course it did. None of us had ever been through such a bombardment of negativity ever before, unless we'd grown up in incredibly difficult and persistent circumstances. None of us had ever felt so at risk, or lonely, or scared at some points, I'm sure. So, the more it changes, the more it stays the same. What do the banks say about the concertina, as I've taken to calling it? This is the pushing up of minimum wage jobs towards the more skilled or more senior positions, meaning only a small uplift above the minimum for much more responsibility or importance to a company. Well, here's the more formal commentary. Some contacts of the bank's agents report that they're coming under pressure to maintain pay differentials between scales. People aren't stupid and they'll vote with their feet, but I suspect will be pushed even harder before they vote. Some of these redistributive measures, noble in theory, are often addressed by taking something from everyone's pockets. Most are all for redistribution until it's their resources, compensation or money that is being redistributed. The other side of the same coin is that price increases become more of a habit. Rent is a great example, as I said earlier. From the expectation being rent staying the same in a tenancy to the expectation that rent goes up each year, and indeed that is even being legislated as the maximum number of rent rises per year is made 1. This all forms part of secular inflation that I've referred to time and again since February 2021. The mistake, as so often, was getting people getting into a city or united argument where it had to be transitory or secular. The reality is always the same. It's a bit of both. It's just how much of one and how much of the other. And then how long is a transitory period? As was flippantly said 3 years ago, if it takes 5 or 10 years to pass, it's still transitory. If this case does play out, and I see it as a much more likely outcome than the Bank of England do, then here's another phrase to consider. Alternative cases would necessitate different future monetary policy stances to ensure that inflation is returned sustainably to target. Now, what they're really saying here is if there's more secular inflation, there's longer and higher rates. Or a change in the inflation target, of course, which is the right solution, as I've said. Although that needs collaboration with the ECB and the Federal Reserve at a minimum. On the bright side, this is a very similar set of circumstances to the US. The Eurozone, on the other hand, has fewer of these problems and less need to move their inflation target upwards. Perhaps it will never happen. In the best circumstances, at the pace these folks work, it would be 2030 at least anyway. So I'm not going to spend a lot of time talking about it until nearer a realistic time for it to be considered. The bond markets wouldn't like it, by the way. Inflation means bonds are less attractive. So we do need to be careful what we wish for. What we need to wish for more than anything is a competent chancellor like a Reeves, even if we politically and ideologically disagree with her. She's credible, and the bond markets won't be going wild with her at the helm. When I shudder at reforms, economic policies and the lack of nous, who, by the way, I see as a real force with 20% plus support in the next election almost inevitably, or we remember back to my favourite lettuce of all, old Blue Plaque herself, I remember my affirmations and my gratitude that we have a competent team in number 11 at this time. The bank then goes through the new fiscal rules. I'm not sure mega detail's going to add value here. Really, you want to know that Reeves has found a way to invest without causing too much upset, and that's good for the country in the long term, which is very rare for a politician. But the game I suspect she's playing here is that the next Parliament looks quite good in her final budget of this Parliament, and so she can nick a bit from the future to get re-elected. But perhaps I'm being too cynical. I doubt I am. The key conclusion, the bank expects this higher growth rate, 0.75% compared to before the budget for 2025, which helps with near-term forecasts, but doesn't strengthen the case for rate cuts at all. The only help is job losses, perversely, for rate cuts. One more item from the report, though, I just want to focus on before the wrap-up. Development in household savings. I spoke earlier of the difference in consumption attitudes compared to before the pandemic. If there's one real skill that Boris Johnson had, or has, it is to make people feel positive. Optimistic, even. Wildly optimistic. Donald Trump shares the same ability. The reality is neither deliver on their promises, mostly because their promises are so outrageous. Some are happy shooting for the moon and settling for the stars, so they're okay. Some just want to feel some hope in their lives, and to feel like their hard work might be rewarded if they make it to be rich one day. The American dream, etc., etc. Starmer strikes me as the polar opposite on this front. All I seem to pick up is negative vibes, even from his very appearance. And that's a terrible thing to say in a way, because we shouldn't judge books by their covers, but in the real world people do. If I'm not alone in that, that in itself is worth negative 0.25% a year in GDP, if not more. And I'm deadly serious when I say that. If people feel negative, they will save. People also, for the first time in forever it would seem, have an incentive to actually save, and stronger for longer rates, yet again, will preserve that incentive. Saving rates are real in real terms, as in they're ahead of inflation. They're staying there for years, it seems, right now. Post-tax, well, depends what you earn, but there's plenty of ISA allowance. Remember, there's £1 trillion worth of ISA allowance in the UK, which is a lot. Half of this is battle, half is psychology. Do we need to be concerned over the next crisis? If we think we do, we save at 0% interest rates. When we save, we don't consume. When we don't consume, money has lower velocity, creates less economic activity, less bang for buck, and the economy suffers. It's a negative spiral or a vicious circle. We need to inspire that confidence in the UK consumer to come back to where they were 5 or 6 years ago. Now, pandemic scars don't heal immediately. Once we have a fiscal statement in spring that is not a budget, that's what we've been promised, with no tax rises, perhaps that will inspire some confidence. I'm not optimistic about Labour's weak communication strategy being able to boost the economy as per Boris's boosterisms, arguably his only redeeming quality. Anyway, that's just my view. What does the bank think? Now, the bank are more pure-blood economists, and they explain it all thanks to the interest rate. They recognise the savings rate is way above the pre-pandemic level. Now, the savings rate is the percentage of household income that gets saved rather than consumed. Right? You can only do, as far as the economists are concerned, you can only do two things with your household income. You save it or you spend it. Simple as that. There might be an extent of rebuilding reserves that were used at the bottom of the cost of living crisis. Sounds reasonable. The bank also points to research around the savings ratio and the likelihood of demographics to play a part, and so income growth itself will not change the savings ratio much. The bank shares some interesting survey results as well. Those who've answered indeed confirmed that higher rates were a big part of their decision-making process, but also that future increases in housing costs were a significant part. 1/6 of all households who were saving more than before were doing so in preparation for a rent or mortgage increase. That factor goes away, but only over the next 3 years, as rents calm, probably, and the old cheap debt expires. The number that the bank has quoted before is that around 30% of the future cost increase has been found by a decrease in household consumption. So some will then come from interest, and presumably the rest comes from higher incomes. Those whose payments have already got up have cut back more. They've cut about 60% of the cost of those payments from their consumption. It's quite a dramatic shift. So what they're saying there is, if your cost base every month has gone up by £500, you've cut £300 from your spending, and presumably the other 200 is coming from higher incomes, or you're having to borrow it from somewhere. So the new prediction is a drop in the savings rate from just under 10% to 8.4% at the end of the forecast period. The interest rate path will make a big difference to how that plays out, that much seems clear, but also the path looks quite clear at the moment. But here comes the wrap-up, my favourite part of the report, not just the end, but the other forecasters' expectations. I've been an outlier on some time for these for the past nearly 4 years, but I've come back a bit closer to the pack in recent reports. There's limited mileage this time out because this was all pre-budget. This time round though, note that the bank is outside of the forecast on inflation by some amount, although they have done their budgetary analysis before this report. I'd be near the top of the bars on growth, so at the higher end, mid-top on unemployment, so mid to highest end, and I'd still be completely above the bars on the inflation side of things, which is a long-held position which I've wavered on at points, but not seen enough to move away from. And I've included that as this week's image, as there were so many images to choose from this week. But ultimately it's a reminder that we're in the game of trying to predict the future with some accuracy in order to run a profitable and sustainable low-risk property business, regardless of what the external environment throws at us. And just remember, if the events of the last week got you down at all, if you're anxious about Trump, for example, be objective. He did it once before. Things went okay. Some things even went well. Some was luck, some was judgment. The US, democracy, the Western world and the rule of law will survive. There will be some hairy moments. There'll be some comedy too. They're eating the dogs, etc., etc. Roll with it. We're safe housed, enormously wealthy by worldwide standards, filled with opportunity, unshakable, unbeatable, indefatigable. Stay strong, keep it real, and put it into context. And most of all, channel it. Now, before I call it to a close one more time, a reminder that tickets for the next Property Business Workshop are out Thursday, January the 16th, 2025, with some great subject matter, planning, efficiencies, and also financial accounting and bookkeeping. This is not how to use Xero. This is how to ensure reporting is set up correctly and how to monitor it on an effective ongoing monthly basis. Come along and get your strategic planning sorted out. And your January kick up the backside comes as part of that package as well. The super early bird tickets are available. A genuine 25+% face value discount on them. Once they're gone, they're gone. More than half of them are gone already. Rod and I hope to see you there. Buy one at bit.ly/PBWFIVE. And look, there's only one way to deal with all of this ongoing noise and excitement. And you know what I'm going to say. Keep calm, always listen to the supplement, and carry on. Thanks for listening, folks.